Good morning. It's Wednesday, the 25th of September, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The fear of a real stock market scam. It's too early to say whether a scam has been perpetrated, at least of the scale that we've seen before in India's financial markets, but it's quite clear that many financial market players have played fast and loose with rules and have also been hauled up for it. All thanks to a booming market in financial products of all kinds as investors and savers have sought to find better returns. These range from non-bank finance companies dispersing gold loans to banks going all guns out on opening fresh savers accounts to now investment banks helping small companies raise funds from the stock market. My fear, could there be something bigger lurking behind the record high indices and the stretched valuations of many companies in the stock markets? Reuters is reporting that it has found that at least half a dozen small investment banks have charged companies the fees equivalent to 15% of the funds they raised via their initial public offer. The problem, that fee is much higher than the standard price of 1 to 3% in India. Now, the modus operandi actually becomes quite clear now. Working backwards, companies and promoters have evidently and obviously paid a substantial sum to investment banks to coordinate the whole process and offer, including bringing in the big subscriptions from high net worth and other investors, and then rake in the retail subscription that follows. SEBI actually has been warning investors about the dangers of investing in some small businesses as well as plans for tighter rules for such IPOs, according to Reuters. Now, SMEs are companies typically who raise or rather are smaller than 250 crores in turnover or less than that and can list on the Bombay Stock Exchange and the National Stock Exchange. Moreover, there are fewer disclosure requirements and the offerings are vetted by the exchanges and not the SEBI, which focuses on larger or what they call main board issues. Reuters says SEBI's preliminary findings suggest that the high fees are being charged to ensure that the offerings are oversubscribed via huge bids. According to the source who spoke to Reuters, the bids are not genuine and are cancelled at the time of allotment, but the high subscriptions end up attracting more bids and investments from other investors. So in the last fiscal year that ended in March 31st or on March 31st, 2024, about 205 small companies raised about 6,000 crore rupees, and that was up from the 125 that raised about 2,200 crore rupees a year earlier, according to Prime Database, a capital markets data provider. Now, rigging prices or initial public offers in this case by cornering floating stock is actually a methodology that seems almost as old as the market itself. And it's interesting that it has returned in full form and glory if that's what's happened here. Now, the worry, of course, is that if there is effective rigging happening in this segment or corner of the market, could there be malfeasance in other segments of the stock market too? Well, we don't know, and we hope that is not the case. But all bull markets usually see such signs before they start fizzling out, and I mean the markets themselves, if not crashing. Indian markets have had genuine and considerable flows of capital, both from domestic and institutional investors at levels we've not seen before, particularly domestic, and that is keeping the markets up and away. But mini scams like this, which expose chinks in the armor, so to speak, can shake the confidence in the overall system and lead to questions elsewhere and about everything. Hopefully, the SEBI will act quickly and nail the offenders and make public the nature of the mischief that investment bankers have allegedly been up to. And the top stories and themes for the day: the major indices take a pause, the metal stocks shine on China's stimulus. JP Morgan highlights the India manufacturing opportunity. Will India's IT sector have better quarters ahead? S&P maintains a India growth rate at 6.8%. China unveils a series of monetary measures to boost its economy and speaks of propping up the stock markets. And how Indian banks are surviving through institutional deposits as retail fail to keep pace.
This is the Core Report with Govindraj Ethiraj.
The markets take another pause. Metal stocks were shining today on the bosses after China unleashed a series of stimulus moves into the markets, and more on that in a moment. But the rest of the market was steady to weak, taking a pause after rising for more than 3 days, and perhaps for the good. The indices did rise to fresh all-time highs late on Tuesday afternoon, but were down later. The Sensex closed down about 15 points to 84,914 after touching a fresh record of 85,163. The Nifty 50 also touched a fresh record high and crossed that 26,000 mark we spoke of yesterday, and it was up by barely a point at 25,940. Stocks like Tata Steel, Tech Mahindra, Mahindra & Mahindra were up quite sharply, while Hindustan Unilever and Ultratech Cement were down. So the Nifty Metal Index was the big gainer, rising close to 3% at close. Sticking to commodities, oil prices have eased off. Now, that's because there's a continued weak outlook for fuel demand and the chance that the conflict between Iran and Israel could de-escalate after its recent flare-up, according to Bloomberg. So Brent crude has now gone back below $74 a barrel. And after days of Israel and Iran-backed Hezbollah trading rocket fire, Iranian President Masoud Pezeshkian said on Monday his country was prepared to de-escalate tensions as long as it saw the same level of commitment on the other side, said Bloomberg, adding that the overture is easing some concerns that the conflict will worsen, threatening oil output in a region that supplies about a third of the world's barrels. JP Morgan, the bull, is back. America's largest bank, JP Morgan, said yesterday in India that it continues to be bullish on India and Japan within Asia and is also keen to allocate resources towards Southeast Asia, which is benefiting from the China Plus One strategy. A top official of the bank said all the bank's top officials, including Jamie Dimon, its CEO, are back in India. India is still firmly in the top 3, possibly top 2 in Asia, together with Japan. Growth in India is actually very broad-based. A JP Morgan Asia Pacific CEO said in an interview on Monday, quoted by Reuters, adding that JP Morgan was investing in India on all fronts, including people and capital. It did highlight a focus on the manufacturing ecosystem, saying India would need to build further in manufacturing to ensure scalability and gain from the China Plus One strategy, or diversifying investment and supply chains from China into other countries. And that's really what China Plus One is about. But most of this, the official pointed out, is actually flowed into the Southeast Asian countries, which includes countries like Vietnam. According to him, if the manufacturing-focused strategy does not work, then India may not do as well as people expect. And that's probably the hardest to execute, he said, adding that he still expected India could succeed. JP Morgan's China business has been growing significantly, by the way, and despite concerns about slow economic growth, the country cannot be ignored. But the new theme, as I could take away at least, is Southeast Asia. JP Morgan wants to invest in Southeast Asia, where the size of the combined economies is around $3 trillion, making it almost as big as India, according to them. Obviously, that makes it a little difficult to navigate because it's fragmented across 5 or 6 countries, but that's a place where JP Morgan says it's key to invest. Meanwhile, India's IT stocks have been looking up precisely because banks like JP Morgan have said that they are hiking their spends in technology back home. Now, the question is, will IT companies in India benefit, and to what extent, particularly the big ones? Also, IT stocks have been rising once again on hopes, but their underlying growth has been somewhat stagnant in the last couple of years. Could that change? I asked this question to Rahul Jain, Vice President Research at Dolat Capital and IT sector analyst, and I began by asking him how he was seeing fortunes for the IT companies ahead.
Basically, what we are seeing, basis the commentary that we heard post the Q1 call, is that things are improving for better, but these things very uniform across the player, across the sector, and is it affecting or benefiting all the player in the same manner? That's not happening. Directionally, things are turning better, and people are expected to see a better traction in terms of commentary as well as delivery in Q2. Specific to your question related to the rate reaction, I think this was long due. So there should be visible positive thought process that should come from a BFSI perspective, but will it still be cautioned around is something that we have to see. So that's what we are thinking about.
Okay, and you said that all companies will not benefit similarly. So can you elaborate on that?
This is what we also observed in Q1. If you look at, there were companies which already saw BFSI doing well, while some others said, yes, it is happening for this quarter, but will it be sustaining is something that people are still non-committed about. So I think commitment would only come once hear that kind of conversation from their client. Otherwise, it's more like better than the last year or better than the last quarter. But how sustainable is that is vendor to vendor.
And how are you seeing overall valuations versus the outlook for the IT sector? So things are all right. I mean, but obviously the top line growth has slowed down in recent years. And this is a broader question. At the same time, valuations have picked up again. So how are you seeing this?
I mean, just like any other part of the market in terms of valuation, I think valuation are discounting anything that can happen very fast. So market has been anticipating a much faster recovery in the IT sector for last 12 months, and we see a lot of starts and fail in the past. And this time it's no different. So I think the valuation are at stretch. It kinds of build in a significant improvement in terms of financial performance. But if it does not fall through, then obviously these are rich valuation and may not be sustainable.
Right. And what's the medium-term outlook like for IT industry? I mean, that is the IT majors in India. And the subset to that question is anything likely to stand out now going forward? And the other part is, of course, what do things look like for the next 6 months or so?
Just like different part of the market, I think valuations are discounting all the positive that could happen. And that adds significant amount of risk because the financial growth could be slightly slower. And in case it does not happen to the pace that is anticipated, there could be risk to these valuations. So I think in best case, you are at par, and in case you discount, there could be weakness that we may see on the valuation going forward.
And is there anything jumping out, Rahul? And this is the last question, for even within the IT sector universe, is there some, for example, could there be someone who would really or is likely to excel in, let's say, AI kind of offerings or something else?
So I would say IT services businesses are fairly valued to slightly richly valued, but there could be opportunity in the software space. This space has still a very large TAM. These companies can compound much, much faster than IT services and even ER&D space. So I think that is where the businesses have sustained growth in the last 2 years. And I think that is where we expect the momentum to continue. Just to take example, I think we have seen very strong numbers from software companies supporting the BFSI space, be it like OFSS, Newgen, Nucleus. I think those kind of businesses should continue to do well going forward as well.
Rahul, thank you so much for joining me. S&P maintains growth outlook. So S&P Global Ratings on Tuesday maintained its India growth forecast at 6.8%, while also noting that the Reserve Bank of India may cut interest rates in October, which is next month. In its economic outlook for the Asia-Pacific region, S&P also retained its GDP growth forecast for the financial year 25-26. That's next year at 6.9%. That's higher than this year. S&P said that in India, GDP growth moderated in the June quarter as high interest rates tempered urban demand in line with their projection of 6.8% GDP for the full financial year, that's 24-25. Last year, if you may remember, India's economic growth had touched 8.2%, and most people were predicting that it would slow down from there. S&P also emphasized the centre's focus on fiscal consolidation and also pointed out the Reserve Bank of India has not altered rates since February 2023, maintaining it at about 6.5% for the past 9 policy reviews. Now, of course, with the US Federal Reserve announcing larger than expected cuts, that's about 50 basis points already, and expectations of more, there is a feeling that the Reserve Bank of India should follow. Now, whether or not that actually happens, I guess is not clear at this point. China unveils SOPs. China's central bank unveiled a broad package of monetary stimulus measures, underscoring concerns over slowing growth and depressed investor confidence, according to Bloomberg. The People's Bank of China Governor Pan Gongsheng cut a key short-term interest rate and announced plans to reduce the amount of money banks must hold in reserve to the lowest level at least since 2018. Bloomberg said that he appeared also at a rare briefing alongside 2 of China's other top financial regulators in Beijing, and that also marked the first time reductions to both measures were revealed on the same day since at least 2015. Bloomberg also said that these moves were followed by a slew of other announcements which pushed up the stock markets, including a package to shore up China's challenged property sector, which also included lowering borrowing costs on as much as $5.3 trillion in mortgages and easing rules for second home purchases. The central bank would also provide at least about $113 billion of liquidity support, adding that officials were studying setting up a market stabilization fund, said Bloomberg. Now, this is the equivalent of the Reserve Bank of India creating a special fund to invest in the stock markets to prop it up, by the way. An analyst at Eastspring Investments Hong Kong told Bloomberg that it was still hard to say what silver bullet could help resolve everything. And while it was good to have monetary easing measures that are accommodative, more needs to be done in order to help solidify fourth quarter growth. So that gives you a sense on how the markets were reading China's stimulus moves. But the markets did rise up, and they rose up almost 4%, close to erasing losses for the year, though the gauge is still down more than 40% from its recent peak in 2021, said Bloomberg. On the other hand, commodities markets gained and pushed up prices elsewhere, including for metal stocks in India. High prices for commodities like steel in China will also mean that prices will rise in India too, or at least could. Indian banks are selling institutional deposits. Indian banks will issue more certificates of deposits, or CDs as they're called, aimed at institutions like mutual funds or companies to meet year-end loan demand as deposit mobilization remains challenging, according to bankers who spoke to Reuters. The stock of outstanding certificates of deposit rose to a record high of 5.15 trillion rupees, that's about 515,000 crore rupees, or about $61 billion at the end of August. And since then, says Reuters, banks have issued another 1 trillion rupees of these notes using clearinghouse data, taking the total, I would guess, to about 615,000 crore rupees. Now, certificates of deposit or CDs are debt instruments with maturities of less than 1 year issued by banks and usually picked up by institutions. This also means that retail deposits are not flowing in as desired, despite all the complex financial models being proffered by some to suggest that there was no such problem. Demand is expected to pick up this festive season. Retail sales peak during October to December, and the festive season has already kicked off. Loans in India are growing in double digits thanks to extensive borrowing for consumer spending. However, deposit growth has not kept pace, as we've been pointing out. People are clearly moving money more to other assets, including financial and, of course, real estate, and within financial, stock markets, and quite likely speculative assets like derivatives as well. So bank loans grew about 13.3% year on year in the fortnight to September 6th, while deposits rose about 11.1%, says Reuters, adding that banks' reliance on these short-term notes is likely to persist, despite the Reserve Bank of India urging them to garner more long-term funds to minimize potential asset-liability mismatches. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.